just about 12:15 Eastern Time. And we're back with another edition of what we call Chart the Markets. And I want to thank my friends at FEG Token and smartdefi.com. I suggest you take a moment and go to smartdefi.com, and you can actually understand in the blink of an eye how you can actually create your own token without any programming knowledge at all. And then, of course, BYDFi Exchange, BYDFi, who is our exchange partner. And if you're not on or have not experienced trading on BYDFi, give it a shot, because it is a slick, smooth, clean interface, and it's actually a real pleasure to trade on it. And if you're into meme coins, you should also check out their MoonX platform, which is directly linked to their main platform. So you can find a link to BYDFi, of course, in our Twitter post, or X post, I should say, the invite, and of course at BluntHouseTA on YouTube. You'll find it in the description. So now that that's out of the way, let's talk about what's on this chart. This is a 4-hour chart of DXY, which is the US dollar index. And what do we believe in here, or what do I believe in at Blunthouse Technical Analysis, is that we believe in fibs, fractals, and filters. Something that we can demonstrate kind of on a regular basis how that all works. And on this 4-hour chart, I happened to be in a discussion earlier this morning with someone who actually you're familiar with, who's been in here before, David Nikoski. And we just happened to be looking at this chart, and I did something I do, which is a million times a day. I look for levels. That's what I was doing on this particular time frame, just looking for levels. And this level here is what I found. Now, this was much earlier this morning. And so all I did was, I'm just looking for a consistent bench of past price to simply start. And once I find it, you get a little forensic about maybe where you want to drop your line, because you're trying to simply line up some past price with some relative consistency, right? This is like something that takes 10 seconds. And where I can, I'll try and find those levels that are consistent with either the 5 EMA and or the T line. And I can kind of do that in here. Or close. It's not pin the tail on the donkey. So this was a level that we thought, hey, if this continues to break down, that's what it might find. Honestly, did not think at all it would hit it today, because that's quite a drastic move that you see there. And again, this is the 4-hour chart. This is what the daily chart looks like, just as a reminder. Here's today's candle. And you're showing a sell signal on our script on today's candle. But let's go back to the 4-hour. Couple things that we want to point out. Our job is to try and get you in the trade at the right time, or give you the opportunity to get in the trade at the right time, long before everybody else jumps on. We want to get you in prior to that, but safely. And our 4-hour chart shows us when that was. The 17th of July. Today is the 22nd. Long before we get our confirmation, which is looking like a confirmation of a sell signal on our daily chart. So everybody's going to be talking about the dollar today. Right? Everybody's going to be talking about the dollar today. Here's the candle that you would have entered on. This one here. This green candle on the 4-hour, that's the 17th, is your confirmation on the 4-hour chart. Just so that you can understand visually how early you would have been. However, clearly a safe entry on the 4-hour, and in some cases, the gap down probably would have been a queue for others. But this is your safe entry on the 17th. This is why we do this. Try and give you safe entries long and short, long before the rest of the world jumps in. And look at, if we blow this chart up, there's where the divergence starts. Right? That's what you'd be looking at on your chart. One candle at a time. You're in this trade very early. And at no time, even on a little bit of a move higher, is all you're doing is testing the T-line like we show all the time, and price breaks down. Remember how we talk about impulse moves down? And when they go sideways and don't show any snapback at all, that's a bearish signal? Well, here you go. Perfect example. Do any of these candles get outside the T-line? Not even close. That one barely wicks outside. So you had all of the clues in the world that you needed to stay in the trade short. And then today everybody else thought they'd jump in. But what's more interesting about this, let's just take this 12-hour chart, just to clean it up a touch, make it a little easier to read. And let's just draw some fibs real quick, because, hey, that's what we do here. You can tell a lot about where price might go. Can everybody see that? What's this candle sitting on? 618. I did not know that when I drew the line, although, you know, after a while you kind of understand what that percentage of a retracement looks like visually. So I knew it would be close. I didn't think it would be like literally bang on it. And you know, this candle's not closed, who knows where it's going to close, but the point is that why do we use Fibonacci's and fractal analysis and filters? When I say filters, filtering out all the market BS that doesn't really matter as long as the trend goes your way. Why do we do it? We do it so we have some sort of understanding with a reasonable probability of where price might be going. Is this not a bloody example to the penny of that? And the point is, if you were to draw fibs on this, believing this was the top, and as the pullback continued, of course, it would be easy to identify that, and you decided to short there, what's a logical place that you would short to? Because we believe and understand how this price moves. What would we have picked? How about 618? That's what you'd look at. That's, you know, you're in this, you got to remember, this is several days, right? You're in this trade for a while. And FYI, this stuff pays. There's your fibs laid out right for you. And even if that's where you drew your top, assuming that was the top level, and you looked at your fib ratios and you go, okay, hey, where's 618? Bam, right on top of our level. This stuff works. This is why we do this. And this would be where you short to. Maybe you take a little off along the way down. That's up to you. Is all I'm saying. That's my target. Does it sound a little bit mental when you first look at it? Now, maybe. But the chart doesn't care. Any asset, any time frame, any market. This is how this goes. And we show you every week. Even at the very minimum, very, very minimum, let's say it's your first day trading, buy these ones. How about that? And sell those ones. There's your insurance. There's your money. We make this harder than it needs to be. right? I don't know if it's natural human instinct or our innate ability, but that's what we do. We make this harder than it needs to be. We don't need to reinvent the wheel to figure out where price may want to go. So in order, we talk about this all the time. Why do we use the shorter time frames? So here's a daily chart still of the dollar index. Why do we use the shorter time frames when trying to look into a daily? It's the nesting doll theory, right? You open up one time frame, you see another, and so on and so on and so on. But we do it so that you don't get hit by something that you didn't see coming or was unexpected, or to give you an early opportunity to monetize the chart. That's why we do this. Do we know what comes after this next candle? Nope. I have no idea. Other than what I can see on the chart. And that is, okay, I finally have a confirmation. I have a cross of the 5 EMA down through the T line, which is an indication that I use that the trend is changing in a legitimate way. And there are other parameters going on in the background that are also triggering that signal. So right now, we either get a big snapback or price continues to fall. And what do we do to validate what we're believing? Well, let's look at our stochastic RSI. Look how overbought it was. Starts to roll over. Fisher transform, great for trend moves, right? It was nice and clean on the way up, and it looks like it's going to be nice and clean on the way down. And interestingly enough, we talk about this all the time. Here's your MACD blown up on the daily. When the moving average and signal line is below zero, kind of have in the back of your mind that more bearish things may happen than bullish. That's just like, it's kind of like trading below the 200 MA where you would be considered in a bearish move. Excuse me, or a bearish trend. And where do we see these things fail on these breakouts of the moving average and signal line to the zero level? Like this. This is where they tend to roll over, right near the zero level. And that's what's happening here. So this should make you feel real confident on a daily chart that there's more downside to come. And the only thing that's going to change that is money coming in. But where are we going to see it change? We're going to find it on these shorter time frames. So if you don't chart DXY, it's something that I chart all the time along with oil and then the 10-year and some indexes. I like to know that's the macro look, right? So keep your
Back
eye
on the daily,
on the
back in
daily.
the daily time frame, the parabolic SAR is showing the parabolic above price, and look at it, it's resting at the 22.
Right. So you're walking me right into my next.
There you go.
So here's, I'm going to back up just to the 4 hour for a second, but let me take the fibs off because we're pretty sure where we know where 618 is now. Okay. So where are we going to see on the daily chart in advance? We're going to see it on things like the 4 hour and maybe even the 1 hour, but you might get choppy. So what do we know? Part of the reason why this level is here is because what we were looking for is price to take out the previous wave's low, which is down here. And that previous wave's low just happens to be 618 to the penny. And we've done that. What we don't know is, does the move continue? Well, if we look at our stochastic RSI on the 4 hour, the Fisher transform, which gives us the nice consistent tells on where the direction of price, and then of course our MACD, where the moving average and signal line has broken zero and is still diverged down. It's telling us, to the best of our ability on this 4 hour chart, that price still wants to move in that direction. south, down. And if it, when it, this candle hasn't closed, but technically it's taken out the low, but if it was to continue down, right, if there wasn't enough support here to pull, to hold price, what would it look for? It's going to look for the next low, right? And that's essentially just the anatomy of a breakdown. And all of these things are fractal, right? So what we're looking at on the 4-hour is giving us a tell on what's happening on the 12-hour, and so on, and so on, and so on. And what we start doing is adding, okay, so now we have some levels established, so now we can start to add some moving averages, and these are just the 20, the 50, and the 200, and these are simple moving averages. Right, so on the 4-hour chart, we were trading well above the 20, the 50, and the 200. And what do we talk about when you're trading above those three levels, regardless of time frame? Be looking in the rear view mirror for when price will test the 20. It will do that. It will eventually come back and test the 20 MA. And you can see how many times it's done that. So really, here's your first breakout. You do it here once, twice. You break but continue 3 times, 4 times, 5 times. The 6th time you've broken it. Sooner or later, you know you're going to fail it. And that's why you want to have your eye on those shorter time frames. Now, when it does come back to test it, it doesn't mean it's the end of the world, right? Quite often, it's a pullback to the 20 MA and then you get a continuation. And that's a signal of a very strong move higher. And what you're doing is you're continuing to take out the previous wave's highs and make new ones in that wave. But when you start to break down, what do we know? Well, we knew we were going to come back and test the 20, and of course you gap down, and that's what you did. And you get a little bit of love there for 2 or 3 candles, but eventually it just fails. And where does it fail to? Right down to the next level. Didn't quite hit it, but very close. Bounces up, tests a level again, pulls back, blows through the 50 like it wasn't there, and sat on the 200. None of this. And all while people are looking at candles, FYI, quite often I'm doing this. Because if you're in up here, you don't have to worry about, you're in the driver's seat, right? You're not looking over your shoulder to see who's coming. You're in the driver's seat. You're in the pole position. And what you're being told through here, just through the T line and the 5 EMA, is that you're completely good. And your 5 EMA is red, so that tells you there's some energy in the move down. Simple. Why do I use this? So that I don't have to worry about this nonsense. Because everyone knows that as soon as you're in the trade, all of a sudden something happens in your head, right? And this is why we're trying to make this more automated and instinctual than anything else. You're trading above the 20, the 50, and the 200. Keep an eye out for the pullback. That pullback will test the 20, and if it doesn't, and it could fail, or it could continue. If it continues, it takes out the previous wave's high. If it fails, it looks to take out the previous wave's low, which it did, and so on, and so on, and so on. Break one level, find the next. Break one level, find the next. Break one level, find the next. And again, the divergence is there telling you that you're okay. No need to panic. And yeah, does it take some time to get some conviction, to feel good about what your charts are telling you? Yeah, that doesn't happen overnight. It's okay. Don't beat yourself up about it. You're like, damn, I entered or exited too early. I should have just, done what the chart said. So here's another example. And again, we're just using the Heikin-Ashi model that we've used before, right? Just to demonstrate how simple things can be. But where is your actual entry? Way back here again on our script. And your Heikin-Ashi methodology really only kicked in at this candle here. And there's a value in using two methodologies like this, like using our script where we're actually getting signals on certain parameters and using something like this Heikin-Ashi system to back it up. I would have been very comfortable taking that trade. In this case, Heikin-Ashi stuff ended up being a little bit late, but everywhere else, it was pretty much right on time. And in some cases, maybe even a little bit early. But when you work off these two, you'll have something to validate by. There's our daily dollar chart. Parabolic above price is your entry candle. And if I take off the Heikin-Ashis and we put back on just our regular candles, let's see what else shows up. Your sell signal. And the only reason that happens is because of how the Heikin-Ashis calculate their price, because there's a look back. But basically, if you were to flip your candles on and off, you would be getting confirmation on both. So there's obviously something going on here. Now, let's look at Bitcoin. Because who doesn't want to look at Bitcoin? Right? I'm going to take these parabolics off for just one moment. Okay. So this is the same Bitcoin chart that we've been using for a very long time. This horizontal yellow line is the line that we drew on the 4-hour chart in one of our streams a while back, when we were able to connect our first kind of consistent little top here, which kind of proved to be very relevant over time. Now, if I just bring this into view, there we go. Now, we've had our big impulse up, made a new high, everybody had a little bit of their own personal parade, whatever that was, and then it's back to business. So, could we clearly see on the 4-hour the little bit of a pullback? Sure. What I want you to notice, though, is that your price has just simply gone sideways, because we have three choices. Price is going to go up, down, or sideways. This is one of those examples where it's decided to go sideways, and you can see, because your point of control within your volume profile is identifying that for you, and that's acting as a real kind of almost like a ground right now for price. But the fact that it has not broken down and has gone sideways, where now you have like your 20-day moving average on the 4-hour, your 50 on the 4-hour, are all twisting together in here and flattening out. And we know what happens when that takes place. The move coming out of there is usually pretty substantial. So if this is to unfold, again, where would price go? We have three choices. If it decides to move higher, what are you going to be looking for? You're going to look to take out the previous wave's highs. That's your upside opportunity. The sideways chatter we can easily identify, and that just essentially goes nowhere. If we fall into, so we pull back, we don't hold the point of control, and you fall into the volume gap, we've demonstrated week in, week out what happens. This can be equally as quick to the downside as this was to the upside. And it's because of this that this big gap is here, and these candles aren't filled with enough substance to hold price up on the way down, and that's why it finds our levels quickly. So when we drew this line, we talked about how it may be relevant in the future. If the breakdown happens, we may find out if that's true or not. But we know that if we were to break down, if we break one level and we know we find the next, let's keep in mind that These are sitting on top of one another, so the next level's down here. Maybe the 100 might be somewhere in here if we were to check it. Let's do it. Yeah. So that's, might catch a break there, but that's the downside risk, level by level. So you move higher, you start looking for these previous highs with the hopes that you take out this one and then make a new one and then rinse and repeat. When we look on the daily, gotta love this, right? Right at the 20 and the 50-day moving average, and price is just essentially, even on this pullback, right in here. Did our 5 EMA show the fade? And yeah, it did. But did they break down? No, they didn't. The divergence stays. So when the divergence stays, the trend stays. As scary as it may look, that's what happens. And again, we just back it up on the 4-hour to find it. And when we look at some of our other indicators, the softening in the stochastic RSI and the Fisher transform doesn't scare me when price holds a range. What's interesting is that your moving average and signal line on your MACD on the daily are still well above zero, and the histograms that you created on your MACD, by the way, are, although red, they're negligible in size, which means there's just not a lot there. So this is, I would expect actually a push up based on what I'm looking at now. And keep in mind, every time you go higher, it's basically price exploration all over again, and everybody loses their minds. The only thing you can do is just follow the chart, right? You're indifferent to price. You don't care if it goes up, you don't care if it goes down. You have one job, and that's to monetize the chart. This weekly, if it was to break down, could get a little on the scary side. Why? Because we had a parabolic run up, which spreads out our ranges that we've shown that we come back and take care of. We know that happens. What do we know about this? That gray area on your volume profile. We know it's super light trading, right? And we know that light trading has less ability to hold price up when it gets retraced, and that goes both directions. And we know what the volume gaps do. But what happens to price inside volume gaps while in this kind of grayed out area is intensified. Right? And we're not going to go up forever. Like at some point in time, even this weekly chart, that's like, look, nice move higher. You come back to the 50, you get a continuation off the weekly. It happens again. So that you're going to come back and check the 20, right? It's just a matter of when. As long as you see that divergence is price bullish on this time frame, yes. But are you trading above the 20, the 50, and the 200? Absolutely. So you're vulnerable to that looking over your shoulder part, right? And getting hit by something that you didn't see coming if you're not paying attention. And paying attention is multi-time frame analysis, which is essentially fractals. And that's why it matters. Sorry. Some things don't like volume profiles. Let's just take a couple things off this chart. U.S. oil, right? What am I looking at here? So you can see. This is the monthly chart. It's important to understand when we look at our charts that, hey, after a while, when we're using the same indicators all the time, like I use a suite of moving averages, and then the 5 EMA and the T line, which is the 8 EMA, you kind of forget that they represent a certain amount of time. Like as a trader, you kind of get fixated on the levels and, you know, the trading in and out and so on and so forth. But let's put some context around the amount of time that we're talking about. This is a monthly chart of US oil. And what you see on the chart in that pink line is a 500-day moving average, simple moving average on a monthly chart, and that represents 41 years. 41 years of price history is wrapped up into that. And it's relevant. This is a kind of a process of elimination, or like as a good friend of mine says, you know, if this, then next that, and all that kind of almost like regimented programming mentality. And when you put it all together, it tells a story. And there's a story that's being told in the oil markets for a long time. No matter what we hear and what we want or what we read or all that nonsense, what people are forecasting. If you're a trader, what's more important? An analyst forecast or what you see here? What you see on the chart matters, because that's the only thing that matters. Look how price treated 41 years before it decided to break it and retest it. Again, monthly chart. 1, 2, 3, 4, 5. You know, you spent three-quarters of a year almost under it. And now we're going to likely come back and retest it again. So in your experience, when you come back and retest and fail, if this was to fail, let's say it was an hourly chart, you'd be like, damn, that's not a good thing. Is it more or less of a good thing on a long-term time frame? Maybe more of a bad thing. This thing has to trade meaningfully, as it's literally demonstrating what it's doing here. It has to trade meaningfully above there, that trend line. And that's going to be, we're going to throw those averages on again and see where you get. Because, you know, there's the 50, 80, just under $80. Does it look like it wants to trade above $80? Anyone? Not yet. One day it will. I'm sure of it. It's just not today. And probably not tomorrow or the day after that or the day after that or the day after that or the day after that. So it's not yet. And you know what? When the money comes in and price wants to go up, yeah, I'm all for that. Talk about that all day long. And we can pick targets on where we think it's going to go and so on and so forth based on the chart, not based on a narrative or based on what someone believes or someone's experience in the oil business or whatever. I find all that interesting, but at the end of the day, I don't give a shit. This is what matters. Price on a chart. Everyone's got great ideas. But let's just talk about where we are, right? So 1 second. Oops. Okay. SPY Weekly, which is the S&P ETF. What do we know about where we're trading? Well, we're trading above the lower value range, the point of control, and the upper value range, and we're trading in all of this gray. And so basically all of this is lighter volume than what you're seeing down here. That's how it's represented in color. So we know that's lighter trading, and I always consider this to be a premium. Right? This is where the value ranges are. This is a premium. On the downside, it would be a discount, but right now, this is a premium. Is it a bullish chart? Yes. Obviously, you're trading above the T line, above the 5 EMA. You've had a clear a buy signal on the weekly. Are you getting a little toppy on the weekly? Yes. But toppy to where? Like if you were toppy on the weekly, where do you come back to? There's your 20. What else can we find? So what gets sketchy here? When you pull back, we know we're coming to the 20, right? Any time frame, any asset, any market, we show it all the time. You can be trading above it and get continuations, but the only way you get continuations is to come and meet it. And in order to meet it, you'd have to break that previous high on the way down, and lo and behold, it's not alone, right? The 20 and the 50 are going to act as a draw for price at some point in time. Right? Still a bullish chart, yes, but these will act as a draw for price. And this isn't necessarily technical. However, I can't help but feel uneasy up here. It's just me. Maybe I'm a scaredy cat. I don't know. But look, this has been trading like with the pedal to the metal for a very long time, in conditions that are not consistent with what markets like. Markets like consistency. They want to be able to expect everything in advance. They don't like surprises. We have none of that. So there's this divergence that exists that is a little spooky, and not just in a lot of ways, right? Just in a lot of ways. Here's the 4-hour SPY. Is bullish as heck. You're still trading actually up in a premium range on the 4-hour. However, it doesn't look like it is totally breaking down, does it? As all these are, on the 4-hour at least, are just 2 red candles in an uptrend. Just like there were 3 here in an uptrend and 3 red candles here in an uptrend. So at this point, you're not panicked, right? You just keep looking over your shoulder till you find something that does scare you. There's the 1-hour SPY. That doesn't scare me. This actually looks like it might want to roll over, at least challenge the 5 EMA and the T line. This is what it has to break out of in order to be taken seriously. And it's just the ebb and flow of price. And whether or not you want to use regular candles or Heiken Ashi candles, whatever helps you, right? Your process will evolve over time. And that's okay. There is nothing wrong with that. That's what's supposed to happen. I am looking for the 10-year. Sorry, take the volume profile off. Okay. So, this is the 10-year U.S. government bonds. Now, does this chart in some senses not look unlike the Bitcoin chart that we looked at where price just went sideways after a big move up? Although you don't have the 50 MA in there as well in this case, but similar sideways action. So although we've pulled back, is it still a bullish chart? Yeah, it is. At least on the monthly for now, right? Do I still think it wants this? I do. But, you can see what's going on. There's nothing going to be surprising you here. And when we back the truck up and we look at the weekly, what do we find? Well, here we are, grinding between the 20 and the 50 MA. Sideways. And what do we know about sideways price action? That when it unloads to the upside or the downside, it's going to do it with some meaning. And I don't think this is going to be any exception. Downside risk, 200 weekly, or downside opportunity, depending on how you want to trade it. But that's your level, and then to the upside, there's 5%. We have no idea what comes after this weekly candle. Next week, we could tag the 50 and then bounce higher and then start to take out the previous wave's highs. Who knows? But everything is respective of time frame because everything is fractal. You can be bullish on and bearish on the same chart because you're trading different time frames. Right? You can be a long-term investor in something, but be short it another way, as a hedge even, right? Here's your daily 10-year. And what's happening? Move up, roll over, break one level, find the next, break one level. We're going to have to look for the next, won't we? Broke that. There you go. And that's the 500-day moving average on the daily chart. It's got to rest on something. It doesn't seem to be too unfamiliar with it. Looks like it's seen it many times before. So, to come back to, what is that, almost 43429, that's wouldn't be unreasonable, right? And this is what trading is all about, right? From one level to the next level to the next level. Some of you will be better trading long. Some of you will be better trading short. It's okay. Some of you will be better traders than chartists. Some of you will be better chartists than traders. Right? We're not going to be great at everything, but we can try to be better. And that's all we're doing. And we're just trying to keep it simple for you. Right? This is proving in our methodology to be the safe entry. And I kind of put that in quotes. The safe entry. That's what our system and script is designed to do. But now we design it in such a way that it allows us to see, kind of sense the fade. And if we decide the setup is correct, that we can take advantage of even an earlier entry. And this, of course, this works long and short. All right. Making sense so far? Like, it's actually really good to come back and see some of these things that we look at, week in, week out. That's yikes. Okay. If I sound surprised, it's simply because I guess I don't get to look at as many charts as I think I get to. And sometimes I'm surprised. So here we go. Here's daily Solana. That's not a bad run. Now, if you were trading this chart, would you be thinking about, oh my God, should I sell? No. Even in here. No. Did our system get you in at a safe entry? Yep. Keep in mind, this is what you would be looking at. And some of you would be PO'd because you're saying, oh, I missed the bottom. I missed the bottom. Well, the job is not to pick the bottoms, right? The job is to monetize the chart. And one of the ways you do that is by making a safe entry. That's critical. It certainly helps. And what we've designed here does that. It gives you that safe entry. Is it perfect? No, nothing's perfect all the time, but it works really, really well. So there's your entry candle. And even that sideways price action, the stuff that makes you absolutely mental, and you would have to make a decision on whether you thought this was dead money or you were still on the right track. At no time did the 5 AMA cross through the T line. At no time did you get a sell signal. Yeah, you closed below it a few times, but guess who's here to help? the 20 MA. Well, getting support from the 20. The 5 MA and the T-line are still diverged. My resistance is absolutely clear, which you know is the 50. And eventually, you get what you're looking for, right? You had your early entry. And in fact, if we back this up, this is which day? The 28th. Let's go to the 4-hour and see when we actually got the signal on the 4-hour. The 15th. And if you're used to trading the 4-hour, you'd be looking at this candle where you finally get your signal going, damn it, I gave away all this at the bottom. You kind of get the point. The point is not to pick bottoms. The point is to monetize the chart in a safe and effective way. And that's what this is designed to do. So on the 15th, you actually had your entry. And what did that look like? Where was the 15th? Right here. Right there. It's actually long before this. Got to be back here. Nevertheless, you had a huge run head start. Actually, would have been back here. Yeah. And there's no reason. Here's what happens. You start to look at so many time frames at one time that you kind of forget where you started and why you were there in the first place. Right? So if this is the time frame you want to trade, the daily, let's say you want to take daily signals, is it okay to back up your chart to the 4-hour to try and find an earlier entry and or to make sure you're not going to get hit by something you didn't see coming? Absolutely. If your objective is to trade that daily and catch a run and hold it as long as you can, monetize the leg as long as it is, then you have the ability to look back on the 4-hour and catch a good entry. And same for an exit. That's where you would see something that might unnerve you. But this is pretty easy stuff. Like if Rico was here, I think he'd be just flipping out because he's probably all over this. And once you catch an early entry, then you're in the driver's seat. That's our goal. And then you can manage the trade. And you'll have no one to blame but yourself when you're in that early. You can't blame the market. You can't blame anything. It's because you did something that you shouldn't have done. So if you're in back down here and for some reason you thought it was best that you entered in here, I'm just making up an example, and then price took off and for whatever reason you missed the run and the next time you see the chart it's up here, whose fault is that? That's your fault. And then that comes back to, are you patient enough? Do you have a plan? Do you use a trading journal? Because if you don't have a plan and you're not using a journal, and listen, I'm not asking you to be a teenage girl in your bedroom in the middle of the night writing down all that stuff. You can do it quite quickly while you're trading. That's not what I'm getting at. But you need to be able to reflect on something so that you can look back and have benchmarks of success and identifiers of potential failures. And over time, continue to refine what you do so that you get better. And it doesn't matter, which methodology you use to get better. I really don't care. As long as it's proven, as long as it, mitigates the risk for you and helps you monetize the chart to the best of its ability. That's okay. But everything that you need to know is on your chart. Double top failure of the 200 MA, that's kind of TA 101. Those failures of the 200 put you in that quote unquote bearish sentiment. Here's your breakout. The real move is down here, but here's your breakout of the 200. All bullish. Whoops, weekly. Where do you think this wants to go weekly? It took out this high, So now it's looking for the next one. And that next one is way up here at 252. Now that's a weekly target, so does it take some time to get there? It's not going to happen in one candle. Nothing goes straight up or down. But that would be a target. And then you're into new highs. So, you know, there is a bit of a story in here, right? Let's look at ETH. Weekly ETH. Holy smokes. What do we see? It's like rocket ship 7, right? It wants back up here again. Took out this high, so what does it want? It wants this one. Now, the scary part is, if you're long, is that you're trading so far above the T line and the 5 EMA. There's an example of what happens. You come back and you meet it. You do it again here, right? Way, way, way above it. You come back and meet. At some point in time, you're going to do something. You did it here. You're going to do something similar. The horse is too far away from the barn, to put it that way. And when that happens, price likes to come back, open that barn door up so the horse can sneak in, take a little bit of a rest, have some food, and then get on about his day. But this is a little hot. And all this is kind of telling you that you're in light trading. We want to back things up and we want to get an idea of, to use our fibs, and let's assume we're going to go on the daily here and take the swing low, and we're assuming that's going to be our high. 2768. This is a level we put on here last week. It is essentially 618. So when Rico was in last week, we drew this line, I believe. And this line is looking like it's going to be 618 on a fib retracement. So what does that mean? It means the same that this did. Right? Same. Any asset, any time frame, any market, same thing. Remember how we had the fibs? Swing low. Whoops. There we go. Swing low, swing high. Boom. Not really different at all. And it's just another testament that there's there's nobody rubbing crystal balls, right? Technical analysis is the language of the market. It's a real-time representation of what money is doing, not what people are saying. It is not a representation of what I think or what anyone else thinks. It is a representation of real money in real time, having real impacts, both up and down. And it behaves in particular ways, repeatedly. And it doesn't care what the time frame is, how big the ranges are, how wide they are. It doesn't care. It has a process that it's going to go through. And is all that we're doing, is all that I do, is use Fibonacci's, fractal analysis, and filters of price so that I can easily distinguish trend. That's it. I wish it was harder than that. It takes a little bit of time, and it's repetition, yes, but it's repetition that can change your life if you want it to. That's up to you. Like, people will come in here and, you talk to me each and every week, but it's up to you to actually do what you need to do. And there are people that are going to be willing to put obstacles in front of you at any opportunity they can. That's just people. And if you really want to do this, you got to get really good at blocking it out. Because all this is just about you and what you do with your knowledge. That's up to you. Learning, asking questions, sometimes taking a little bit of risk, right? And that's when I say that, I mean, when you're new or it's whatever you're doing, sometimes it can be unnerving and that feels risky. But you got to get over that. Because all it is price on a chart, and it doesn't matter the chart. This stuff is the same. Time and time and time again. Right? This is something that I like to trade because I like the price action. That's all. Simple. Just doing the same stuff that we talked and showed earlier in the stream. Just picking a level like what did on DXY. Right, this happened to be on the 1 hour. Here's what it looks like on the 4. It's relevant to me because, hey, you know, it was a top, like on the 1 hour, it showed it being toppy, and I could line up those areas that I want to line up. There's your confirmation. I love this because we talk about this all the time. Right? You get these big candles side by each. And sometimes they're just kind of like big flush candles, right? That's all they're there to do, is make your life miserable and take your money. That's how we interpret them when we see them. And here's the best part. So if you were short and this candle showed up, it may have stopped you out. Like there's all kinds of circumstances. Maybe you pulled the trigger yourself. But the chart's telling us that you're still good. Is all this was. It just turned out to be another opportunity to short. The chart was telling you which way this was going to go. This is not magic or anything like that. This is simple ass stuff that just gives you clues because this is the language of the market and you're just learning how to read it and interpret it. And once you do, you're going to be like, oh my God. The chart was telling you what was going to happen. You don't know that it was going to be a giant red candle, but you knew the trend was down still, right? That's what you knew. So you had an opportunity to re-enter, and you could have done that quite safely, and then the bottom gives out. Right? From there is all you have is an impulse down, sideways. Right? What do we say about these sideways candles that don't show any sort of a snapback? They're bearish. Are these wicks a nightmare? Absolutely. You're probably going to be in and out of here a few times, but if you're trading this thing, you have to be prepared for that. Big picture, this divergence was telling you that the trend was down. The fact that your 5 EMA was still red was telling you that there's a lot of bleeding still to come. And price moves down farther. And what do you think is going to happen here? That maybe we're looking to take out the previous wave's low. Just saying. And if we want to get an idea what that might look on a larger time frame, knowing that these lows are on the 4-hour level, right? Let's back it up. That is roughly 1.2596. 1.2596, somewhere in here, right? So it is the bottom of these candles on the 4-hour. So we take them out. What are we looking for? The previous wave's low, which is where? Anyone? Down here. Let's look at the volume profile, because that'll help us understand how quickly or confidently you can make it from one level to the next. So on the 12-hour, you're starting to show your sell signal, and you're starting to get into this volume gap. You're already in it to a sense because this is the largest shelf you have, the POC. So now you are into a gap. And yes, nothing goes straight up and down, but you're into the gap and it's kind of sucks you down. So in the event of a pullback, as current price looks for past, we got to figure out where those levels are. Now all of a sudden this means something a little bit different, doesn't it? Because price is sitting on the 20 MA on the 12-hour. Is this just another example of a continuation where we then go out and take the previous wave's highs? I don't know. We're going to find out, right? But this is why we do this, so that we can see where price has been and hasn't been. Now we know where the 50 is. This is somewhat of a shelf, probably made up just of this in here. So if we break this level, we find the next. Now some of us may want to put the 100 in there just because we can, and that's going to be, in this case it's below the 50, which is actually not a good sign for price. It means that it wants to pull back here more than anything. If there was anything that it could have bounced off up here, if I was thinking that maybe the 100 would be sitting up in here, but it's not, so that's worse. That's worse. So we just keep repeating the same process over and over again, and you'll see how well it works. If you don't hold the 20, you fall into this gap, you're going to look for this level down here. And because we like to have fun, we're going to take our fibs. This is fun, right? Where you got to pick where the proper levels are. I'm going to take this here. I might be wrong. Where's 618? Anyone? Oh, moving averages don't matter. Blah, blah, blah. That is just lines. They don't mean anything. Bullshit. Anyone else? There's 618 on your 12-hour. So if you didn't use fibs, and is all that you were doing was using our methodology where you're breaking one level and finding the next, you still would have hit it. Don't fight it. Right? Don't fight it. Don't fight what you see on the chart. You just got to roll with it. And sometimes it's going to seem completely unorthodox. I get it, but you can't fight what you see on the chart. We just continue to back up time frames. There's our 4-hour chart. There's your entry. Broke one level. See how we got a little action around the 20? That's completely anticipated. Found the next. Break one level. You'll find the next. And here you are, right between the 50 and the 200, the 100, and it's right in the middle of that gap. Like, I'm always curious about why people think this is really super difficult, right? Clear your minds. Check the ego at the door. If you feel you have one, it's going to be a liability. And just follow the chart. Remember, we're not here to front run anything. We don't get any stickers for that, right? All we're here to do is to monetize the chart to get you in at the right place at the right time safely. And if you have to reverse your trade, then you can do that because you know how to set stops and mitigate that risk. Mitigating the risk is just as important as making a good trade. And sometimes the best trades are the ones you do not make. So if you have a trade set up that doesn't quite feel right, for whatever the case may be, right? It doesn't feel right, or maybe you're trying to make it work. Maybe you're trying to rationalize why you're making a certain trade. Who knows, right? There can be all kinds of reasons why. Follow the chart. Take the right setups. I'm just showing you this chart because it's something that I've taken notice that gets really good moves. I don't think there's any perpetuals on it, so it's probably only spot. But, you know, I like 4-hour charts because they often take a lot of the noise and BS out of the market while still being really good for trend. And you'll see back here, you know, again, this is in May. On the 4-hour, you get a real nice buy signal. And at no time until way up here does it start to get a little bit sketchy. Like, you know, that's well into well into June. That's how you want, like if I'm thinking in a utopian world where I can get a nice run off a 4-hour chart, I think this is what I would expect in my dream for them to look like. Real nice long runs like that. This is clear consolidation. And this would have been your fake breakout, right? So, there you go. And what happens? You take out the previous wave's low. Now, could have bounced and, gotten a huge green candle and life goes on, but that's not what happened, right? You knew, as long as this divergence was in place, that you were short. A nice long run, and then a nice long run higher, and a nice more consolidation, blah. But here's a good run. Love this stuff. And this is spot. But it's a real nice demonstration of how the chart reads. Another nice run, right? You don't really get an exit signal until here. And some, if you're short, you're going to interpret that as a short signal, and then you would short it down. So it doesn't matter the chart. It doesn't matter the time frame. Will some charts be choppier than others? Of course. That's simply, liquidity and flow and so on and so forth. But the charts themselves will always read the same. Right? Here's one that we used to love to watch go up and then went nowhere but down. And is struggling to have any sort of a breakout at all. Right? Yeah, do you have a sell signal? You do, but it's very modest. There's not a lot going on here. But eventually this flat trading, like anything else, will move up or down with some velocity. That we can be certain of. Time and time and time again. Are there any charts you wanted to look at today? Let's look at NVIDIA quick. Delatoshi, if there's anything you want to look at, just say so, or any of you guys. So here's NVIDIA. Daily. Let's pull in our volume profile so that it's in view. There we go. So we know we're trading in an area that's a premium. Let's back up this to the 4-hour chart to see, did we get a Q? No, we didn't get really too much of an early signal. It came today at open. So this is kind of scary because so much of the market is tied to NVIDIA. So just out of curiosity, let's go back to the daily. And like Delatoshi had said, hey, where's the 20? Let's find out. That sits at what? 162.30 roughly. So if this continues, we would expect that perhaps they tag the 20. But if it was to break down, where may it go? Looking for the 50. Keep in mind, all of this is a premium. There's your 50 right at the upper value range. These are just logical places for price to go in the event of a pullback. It's simply price breaking one level and finding the next. Right? And nobody wants to talk about the 200-day on the daily chart being at $133. Nobody wants to talk about that. And they won't. Right? It's not going to be, you're not going to hear it anywhere. It's not going to be a topic of conversation. But you need to know where it is. You're trading above the 20, the 50, and the 200. And at some point in time, you're going to come back and check these levels. And they don't always hold. And you don't want to be on the wrong side of something. That's all. It's not meant to be fear mongering or anything like that. You just need to know where these levels are. If you're long, you want to know where it is because you're hoping for continuations off those levels, right? Where you're constantly making new highs. That's all. This is like an equal opportunity system. It's, it works long, short, and it's indifferent to what price does. It's just there to guide you. That's all it is. Just there to guide you. USD JPY. Something that I think everybody should learn about the carry trade. I don't want to get into it today in any detail because it'll take up too much time. But it's basically the US dollar and Japanese yen. And if we look at it over a longer time frame, I like to try and understand what my downside risk is. Obviously, when I look at a chart, right? I don't just look at the upside opportunity. I used to do that. I don't do that anymore. I start with the downside risk. I've become a better trader as a result, probably because I find that I'm mitigating risk better. So I'm always looking for the downside risk first if I'm looking to go long. And if I want to long this thing, the US dollar, Japanese yen, I'm going to have a tough time making a case. Because this chart reminds me of the weekly oil chart back in 23, of the fall of 23, where you had something, a setup like this at, I don't know, $95 when everyone in the world thought it was going to 120. And then it did this type of thing. And then it made a lower high. And then it pulled back again. And then it made another lower high. In the case of oil, however, it actually reached the trend line. What we're seeing here is, and again, this is not about policy. This isn't about anything. This is just simply what's going on the chart. Here we have a situation where you're trading above the 20, the 50, and the 200-day moving average. You came back and you checked that 20-day like we always talk about. Let's get an idea of what it would have looked like. Right? You know how we don't know what's coming after the current candle that we're looking at? Just going to blow this up a little bit for you. Obviously, you kind of faded that trend line, and our script's sensing the fade, which it's representing in the red, and you start to, that divergence that we talk about that holds you in the long starts to close. But you don't know that's going to happen. You just don't. And the reason I'm showing it is because you don't want to be surprised in the wrong direction. Like if you're thinking about going short, or you're starting to analyze whether you're going short, that should be a pretty convincing candle. Right? No question about it. You have no idea what's coming next. Maybe you expected another small doji or something like that, but no, that's not what you got. You got a far more violent candle that on a weekly chart broke the 20 MA and the 50 MA. Impulse down. There's no snapback to test the T-line. There's no snapback to test the 5 EMA, and in fact, it's still bleeding. Still bleeding. And so impulse down, there's no snapback, and in fact, you can't even break the weekly 50. Wick through it and all that stuff, but ran away like a scared little baby. That divergence was intact, and the market was telling them there's no way you can fight that. You fail the 50 yet again, and you're only going sideways back to these levels that we talk about, and then what happens? Over and over and over we show this. Price goes down. Now, what's important here on this chart is that, so we've broken the 20 and the 50. We're getting a 50-day failure on a weekly chart. Now, you got a 20-day failure here, and it turned out not to be a big deal. Could be the same case, and we won't find out for a week or two. But right now, I don't like the failure of the 50. Failing the 50 is worse, especially on a weekly chart. So here we sit, just barely above the T line. This is really important because, like we demonstrated earlier, how the dollar was falling, it means there's people selling it. Right? That's what's going on. There's people selling it. Here's the daily. Technically, as long as you're trading on the north side, you're bullish. You're trading on the south side, you're bearish. You're not going to jump up and down because price went up or price went down. You just set targets and you're indifferent to what happens. If the trade goes your way, you're out of it. Or doesn't go your way, you're out of it. Hits your target, you're out of it. Concern with this chart is that if it's a bigger problem, the first attempt to the 50, you come back, you're going to test the 20. If you don't hold the 20, you should bounce. But if you don't hold it and you take out the previous wave's low, well, you're chipping away at a level that you're not going to be comfortable with. And then all of a sudden, people are going to be talking about the 200-day monthly for USD JPY. And, if you're on the side of the US dollar, you don't want to start trading below there. But when we look at what's on the chart, because that's all we have to go by, right? We're not into, this isn't about economics. This is about technicals right now. And technically, we're failing the 50, and we know what that means. And we know what draws for price are. It doesn't matter what the asset is. Here we have the point of control at 144.9. That would be a logical target if you don't hold the 20. And of course, if you start to break it, remember that you'd be falling off a shelf in the process of doing that as you're challenging these lows. Break one level, find the next, break one level, maybe find the next. That's the downside. And this is a structural level. That's why it's important. Because if you break the structural level and the 200 weekly, the lower value range is an obvious draw for price. And then how do we get to 130, spot 5? Doing some simple stuff that we do all the time. And I understand this is a weekly chart and it takes time to unfold, blah, blah, blah. What am I doing? I'm looking where the bench is because I know that's what price will sit on. Well, here's some tops and kind of through a bottom. Can do the same in here. Oh, lo and behold, it just so happens to hit the 5 EMA, which is something that will line up time and time again. And hey, there we go. More action there. So that's why this becomes a target. Right? That's it. It's just based on price. This is the language of the market. The real-time representation of what money is doing, not what people are saying. This chart doesn't give a rat's ass about what anybody says about it. It's going to do what money tells it to do. That's what it's charting. It doesn't chart your friggin' opinion or anyone else's. And there's a lot of them out here that think they have one. Some good, some bad. We're all not right all the time. And for those that don't understand how we do things here, because you see a Twitter post that makes no friggin' sense to you because you have no context, message me. I'm happy to tell you and explain it. But if you think that what you're seeing on your chart is just a line, and that's all it is just a line, then you're an idiot. And you don't deserve the explanation. This stuff's not hard, folks. But it is a language. And if you don't learn it, you're never going to figure it out. It's as simple or as complicated as that. Here's oil. Does this look familiar to what we just saw? On USD JPY, kind of seen this movie before, because all this stuff repeats. Any asset, any time frame, any market. Is it going to be a ditto machine copy every time? Of course not. But the principles of how this works, fibs, fractals, and filters, is effective. Where did we say oil's going back to? What did we talk about this 50-day failure? Where did we think price was going to come back to? The 20. This is how price moves until it figures that shit out. And we just have to, we don't even have a sell signal yet. Maybe we won't get one. If price holds, you're going to bounce and test the 50 again. If it fails, guess where you're going? Back to our 61.66 that we called back here. Because this was the level that if the downtrend was to continue, would find past price. Just like on the chart we just looked at. Because it repeats time and time and time again. And the only thing that changes it, and it does change, and eventually the thesis changes, is money coming in or out. That changes direction. But when that happens, you'll be there too. And you won't be surprised by it. Because you know to look forwards, backwards, and sideways. No one's blowing magic potion in anybody's faces. This is just price action. And it behaves a certain way. Sometimes it feels unreasonable and unrealistic, but it does it. Keep an eye on this chart. You're either going to get a continuation off the 20-day, or you break it and you start to check previous levels. If we throw the volume profile on just for a second, this level in here, what is this? $150, I'll just say 155. You know, the bottom of here, these two candles, will probably be an attraction for price. And guess what? Lo and behold, like we showed on the other chart, I bet you the 50 lines up with it at 1.2. I mean, this is just fractal stuff. And if you were to go back and look at, I was having a conversation this morning, if you look at what is the 50 on the, well, let's say the 20. Quite often you'll find on your charts that the 200 on the monthly equals to roughly the 50 on the daily, that type of thing. That's an example of fractals. That's all it is. It's just an easy tool for you to use to track price. That's all we're doing is tracking price. Price is going to go up, price is going to go down. It's not based on your opinion, it's just placed on flow. That's all it is. Money in, money out. And there's ways that we can read it that will help us. Sometimes we can do little things like we showed before, just changing some candles and, hey, using a slightly different methodology to help us manage our trades. That's okay. The Heiken Ashis do give you a real good example of money in and money out. That's it. There's your entry candle. What is this time frame? The weekly. That would have been your entry on the Heiken Ashi methodology, with ours to follow the next week. Either way, you're in the trade safely, and price just rides up this level, divergence completely intact, for you to know that everything is okay and there's nothing to worry about. Those red candles that you see are just red candles in an uptrend in this particular wave, until they're not, and the chart will tell us when that happens. And we just, dial back our time frames to help us catch things in advance. That's it. Any questions, guys? Anyone? Anyone? Because if we don't, I actually have some company at my house, and we can cut this short, and I will open my office door and unlock myself. So if there's any questions, let me know now.
Nah, thank you, Blunt, man. We don't want to keep your company waiting.
No problem. So just remember that everything you see on one time frame, you'll find on another. And mysteriously, your fib levels will probably line up with levels that you would instinctively lay out. Make this a 12-hour to give it a little cleaner look. Right. This was a level that just made sense solely on past price, connecting tops and bottoms of previous candles. That's just something that I do along with, connecting lower highs and that type of stuff. And from there, you overlay your fibs and you're going to go, huh. So I have a pretty good feeling that if I'm going to short this chart, that I can short to 618. That would certainly be a target. And this is just a way for you guys to validate what you're seeing and feeling. Right? You're looking at the chart and you're going, yeah, that looks like a legitimate level. Why don't I throw some fibs on there? Boom. Validated. And you feel better about it. Yeah, you have to manage the trade on the way down, but we show you how to do that. To take the risk out of it. So we'll come back on, I guess, Thursday. We'll take another look and see where we are. But I think if you haven't noticed, there's some consistency and some accuracy to what we talk about and how price behaves. Right? So remember, you don't know what comes after the candle you're looking at, but the chart will give you clues. The chart will always give you clues. Use your multiple time frames to help you manage all of that. Mitigate the risk by keeping your stop losses reasonably tight. And if something goes your way, or goes against you, just get out. Don't even think about it. Just get out and get out quick. And the quicker you get out, the less that becomes a loss, and the sooner you move on. Keep a journal. Make notes. Review things at the end of the week, and don't take setups that don't feel right. I have a handful of criteria that I look for in certain setups. Do I always get every one of them? No, but there's a certain amount that I absolutely have to have, and I won't take the trade without it. So only take the setups that make sense, especially in volatile markets, because if you are just making trades for the sake of making trades because you think that's an effective way of being busy, you're going to have some problems. So that's it for now. Let's come back on Thursday, and don't be afraid to send your notes and things like that in the meantime, and we'll make sure we cover this stuff in our next session. So take care, everybody. Have a great